Horlicks Network 18, Mission Poshan, Bhavishya Roshan.
Thank you very much. Yes, Chetan Ahya is with me. Chetan Ahya is the global economist for Morgan Stanley, and at this point in time, we first have to get the global macros right. So Chetan, you know, I was reading your one of your latest reports. You all are almost seeing a Goldilocks scenario for the world. The global economy growth doesn't look like getting impeded, and inflation won't be such a big threat.
No, all what we are saying is that there are challenges. You are seeing problems in terms of central banks tightening in DM, and so that's going to be definitely some kind of a challenge for growth to continue. But to the extent to which this cycle has been driven by capex and productivity, which has really happened for the first time after the deceleration in capex that we saw since 2012. And so to that extent, it is on a much stronger footing. It takes a lot for a capex-driven cycle to be turned down by the challenges that we are seeing right now.
You know, some of the things that keep that are brought to us as red flags. One is that even in the U.S., the difference between the 10-year yield and the 2-year yield is now, it's almost leading to a flattening curve, and so is there a recession? Fears like these are unfounded, you think?
So actually, I think the comparison on that front would be 90s, when yield curve was flattening, and it was relatively around 50 to 75 basis for a long period of time. And guess what was similar to this cycle? Capex was strong. So if you have productivity-driven, capex-driven growth, then the economy can withstand higher interest rates and does not have a problem then.
Okay. So what about EMs then? Do you think they benefit from this? Or, lately, look at the outlier. Maybe these are only outliers, Turkey, Argentina, but even Indonesia had to raise interest rates. So is there a fear of, dollars moving away from emerging markets?
So look, Lata, the way we approach EM's outlook is that we need to first see how their own policy mixes and macro stability indicators are, and then you evaluate that in the context of rise in interest rates in the US. Now, and in that context, taper tantrum and commodity price fall in 2014-15, we think were the triggers. The reality was that these guys were misallocating. So now when we take all the large EMs, bulk of them are doing fine on policy mix and therefore on macro stability indicators. Look, Indonesia, we were already expecting rate hikes to be taken up. It just got a bit moved forward by a quarter. And honestly, they don't really have that big a problem. I know it got a lot into the media, but if you just look at their currency performance relative to other currencies like Argentina, or even for that matter, Brazil's currency, it's doing okay. So I think it just got a lot of bad media, but underlying fundamentals are fine. So broadly, EMs are doing okay.
Okay. No, I just want to point out to one article written by Dr. Urjit Patel in the Financial Times day before yesterday, where he is saying that if the Fed is shrinking its balance sheet at a time when the US government is going to borrow more, and therefore Dr. Patel argues that dollars will flow towards US treasuries. His fear is, and he quotes data to say in the last 6 weeks, every week $5 billion has moved out of EMs. So he's asking the Fed to, roll out its balance sheet shrinkage by a few more months. That seems to be the crux. Would you worry on those lines, that dollars may flee emerging markets because of what's happening in the US?
I think that is definitely a risk. But I think what is different, as I mentioned to you earlier, compared to 2013, is that the EM fundamentals themselves are fine. Look, whenever you see strength in US data and pick up in inflation, the US 10-year bond yield moves up. And at that point of time, you do see a temporary rise in the dollar and therefore some kind of EM assets repricing. Okay. We've seen that in November 16, we've seen that in November 17, and we've seen that now. Fundamentally, we think that the dollar is going to be weak. It had this tactical rally, and it's going to roll over. Okay. And the reason for that is that rise in fiscal deficit in the US is going to cause widening in US current account deficit. So in that sense, it will be somewhat similar to 2003 to 6, where the Fed was hiking, but you saw that the US current account deficit was widening and dollar was weak, and EMs were fine.
It's always good to think that something like 2003 to 2005 or 6 is on the cards. That's the great growth story everyone wants, without the negativity. But speaking of Governor Patel, what's your sense about the Indian financial conditions? Do you think that are you expecting 1, 2 rate hikes and one today itself?
No, we don't expect the central bank to hike today. Of course, there's always a possibility. But I think looking at the fact that the underlying inflation trend in India is fine, and ultimately that has been the framework that the central bank has provided us. So looking at the trend in inflation, particularly food inflation, which is a big component, it doesn't worry us that the underlying inflation trend is quite okay. On our forecast, we expect the core inflation in India to be going to around 4.3% by March 19. So we think that the trajectory is looking comfortable with the facts that we have. But if you do see a big problem on oil and oil shoots up in a short span of time, then there will be that inflation pressure which the central bank will have to consider. Okay. But I think with the facts that we have, we think they should probably hold today, sound a bit more hawkish and say that, look, that easy monetary policy condition that we had so far is done, and one should be prepared for interest rate hikes in future.
Okay, so a hawkish pause would be more like it today.
Correct.
But for 2018, what are you expecting in terms of rate increases from the Reserve Bank? Will it come in August? Will there be more?
So we see one base case rate hike in last quarter, but we do appreciate the fact that oil prices have moved a bit higher than what we were building in our forecast, and so there is a risk that they could do a rate hike in August.
Okay. Oh, in August. But you only expect one and done?
No, we're expecting two more, so in all 3 hikes in our forecast horizon. So it will be a shallow rate hike cycle, unless you see a big misallocation or redistribution by the government before election, which then brews up inflation in 2019.
So you expect them to point out to those risks?
Absolutely.
So, MSP is one fear that everyone has, and as well farm loan waivers. So if the fiscal deficit were to expand, you think that there would be more than one?
Absolutely.
Okay, let me come to the currency. While of course we are not in the category that Indonesia is, or definitely not anywhere near Turkey, what's your sense? Is the rupee appreciating too much, and therefore a rate hike can actually hurt? In real effective exchange rate terms, just about before this current bout of depreciation, we were overvalued last year. Now I think it's come down to whatever, 15% or 16% overvaluation. So, what's the sense you're getting in the rupee itself?
So look, I think the fundamental valuation of the currency that we look at would be in conjunction with terms of trade. You can't just look at real effective exchange rate and versus trend and say it's overvalued. So we think currency is relatively fairly valued on that metric if you consider terms of trade in the background. And the other evidence is that the trailing current account balances have been fine. So that's also telling you that the underlying valuation of the rupee is fine. And so I think the two variables which we need to consider. First is what happens to the dollar. We always look at rupee in isolation. Everybody asks me, what do you think about the rupee versus the dollar? My counter question is, what do you think is going to happen to euro versus dollar? And so if you see even the recent bout of depreciation, the rupee is actually moved in line with euro, in fact done better than euro.
Yeah,
so
it's much more stable.
it's a function of what happens to the dollar. And as I mentioned earlier, our FX strategy team is forecasting that the dollar will decline. Okay. So I think from that perspective, you should have reduced pressures. And then the other thing is what is going to happen to commodity prices, because terms of trade is also another variable. So if commodity prices rise, then it makes sense for the rupee to depreciate and adjust in line with the terms of trade deterioration.
Okay. Well, the only worry is that we could be headed for 2.6, 2.7 current account deficit in the current year, partly because of crude and partly because our exports are not firing up as much as global growth would expect of our exports. You don't have fears about current account deficit?
No, again, I would go back to 2003 to 6. We had oil prices going up from $30 to 90 from 2002 to 2007, and current account deficit remained around 1.5% of GDP. At that time,
our exports fired. Now you're not worried?
Correct. So the difference is that at that time we had a global environment which was good. Now, global environment is not as good, so exports will not be growing at 25%, but they can definitely grow at 10-15%. So that will be an offset that you need to consider. And then the other backdrop was that it was a productive growth environment. We were not generating growth through misallocation of, by loose fiscal policy or low real interest rates. And so to that extent to which right now we do have that backdrop, that growth is recovering in a productive manner, then you should be able to see that India's exports actually do pick up. I think 1 or 2 months weakness is not something that we are looking at and getting concerned. So our forecast is that the current account deficit should be remaining on a 4-quarter trailing basis in the range of around 2%, and not really widening up to 3%.
Oh, that's good to hear. Just a word back on growth. There could be, as you say, one rate hike. There are some out there who are predicting 2 rate hikes in 2018. What happens to growth? Is this going to be a good year of growth, 7.4 as the RBI had forecast, or less than that?
So on growth, our framework is that you needed a period where you have synchronous recovery in exports and consumption. Look, since the time taper tantrum happened, we've not had either of those. Either you had consumption, at that time exports were bad, or if exports were coming back, we had demonetization holding back consumption, etc. So since last quarter of 2017, we've had a normal environment for both consumption and exports. Capacity utilization has therefore started to improve. So we think growth is actually going to be now finally delivering in the way investors were expecting. It's been a long wait, but finally it's coming through. Look at two-wheeler sales on a 2-year CAGR basis, commercial vehicles, cars. Hindustan Unilever's volume growth in March quarter was up 7.5%. So we are seeing some kind of broad-based recovery right now, and public capex is also doing well. So